For most people, the phrase options trading conjures images of high-risk speculation, hedge funds, and traders chasing quick fortunes. In reality, options can be one of the most powerful and consistent tools for generating passive income when used correctly. The key is understanding that options aren't lottery tickets. They are contracts. And like any business contract, they can be structured to work for you, not against you. An option is a simple agreement tied to a stock. A call option gives the holder the right, but not the obligation, to buy a stock at a fixed price, called the strike price, within a certain period. A put option gives the holder the right to sell under the same conditions. Each contract usually represents 100 shares. For example, if Apple stock trades at $180, a 1-month $185 call option might cost about $3 per share, or $300 per contract. If Apple rises to $190 before the option expires, the buyer can sell the option for about $500, making a $200 profit. But if the stock stays below $185, the option expires worthless, and the buyer loses the entire $300. This is where most beginners go wrong. They buy options, hoping for big moves. Professionals, however, do the opposite. They sell options and collect that $300 up front. They know that time, not emotion, is on their side. According to the Chicago Board Options Exchange, nearly 70% of all options expire worthless. That means the seller, the person collecting the premium, has the mathematical advantage. If you sell that same Apple $185 call option for $3, you immediately pocket $300. If Apple stays below $185, you keep the money. If it rises above $185, you must sell your 100 shares at that price, but you still keep the $300 premium. Either way, you win. This simple but powerful strategy is called a covered call. It's one of the easiest ways to generate monthly income from stocks you already own. Suppose you hold 1,000 shares of Apple. Selling one call option for every 100 shares could generate about $3,000 a month in premiums. That is $36,000 a year, roughly a 10 to 12% annual return, without selling your core investment. You're effectively turning your stock portfolio into a rental property, earning rent from the market. Another variation is the cash-secured put, which works in reverse. Imagine you want to buy Nvidia, but only if it drops to $400. Instead of waiting, you can sell a $400 put option for $8, earning $800 up front. You must keep $40,000 in cash ready, in case the stock falls and you're assigned. If Nvidia stays above $400, you simply keep the $800 for doing nothing. If it falls below $400, you buy it at the price you want it anyway, and your effective cost is $392 after factoring in the premium. In both cases, you win. You either buy the stock cheaper or get paid to wait. This is how professionals use options to their advantage. They don't chase predictions, they create income streams. The beauty of this approach lies in theta decay, also known as time decay. Every day that passes reduces the value of an option. If an option is worth $5 today and loses 10 cents per day in time value, then after 10 days it's worth only $4, even if the stock hasn't moved. For the seller, that's pure profit. Selling options allows you to profit from the passage of time itself. However, successful options trading is not about reckless bets or oversized positions. Professionals treat it like a business. They manage exposure carefully, never risking more than 1 or 2% of their portfolio on a single position. They sell options only on stocks they understand and are comfortable owning. They avoid trading before major events, such as earnings announcements, when volatility spikes. And they focus on high-quality liquid stocks like Apple, Microsoft, or ETFs such as SPY and QQQ, where spreads are tight and execution is fast. Everything they do is cash-secured, no borrowed money, no leverage. Consider a small investor with $50,000. They could allocate $30,000 to stocks and keep $20,000 in cash. Each month, they sell a few covered calls on their stocks and a couple of cash-secured puts on new opportunities. If each option brings in $200 to $300 in premium, that adds up to around $1,200 a month, or $14,400 a year. That's nearly a 29% annualized return, achieved not through speculation, but through discipline, math, and consistency. Even if markets dip, the accumulated premiums cushion the losses, lowering the overall cost basis of each position. This approach turns the market into a source of rent, not risk. It works because the math favors the seller. Around 70% of options expire worthless, which means most of the time, the person collecting the premium wins. The trick is to stay patient and let probability do the work. When you sell options, you're not gambling on direction. You're betting on time. You're not hoping for miracles. You're running a business based on consistent cash flow. In the world of options, you can either be the gambler chasing luck or the house collecting rent. The house always wins because it has the math on its side. So if you want to earn passive income from options trading, stop buying dreams and start selling time. Let the market pay you for your patience. When you understand the math, manage your risk, and stay consistent, options trading stops being speculation and starts becoming strategy. And remember, in the market, as in life, time is money. The smart investor sells both.